To fight the recession, the central banks are flooding the markets with cheap money. The Fed is continuing to focus on its zero-rate policy, and the European Central Bank has cut its interest rate to 0.5%. But can this really help the European countries in crisis? That's what I'm talking about with Stefan Schneider from Deutsche Bank Research. Mr. Schneider, you're analyzing the most important economies around the world. How did the global economy perform in the last month in April?
If you look at the DBIX, we can see that after recovering between November and February this year, it has dropped for the second time in a row, and it's now standing at 0.2, which is slightly above its average.
Why is that? Where come the effects from?
If we look at the developments in the different areas contributing to the DBIX, basically it has been weakness all over the place. The indicators dropped in the US, in Europe, and in Asia.
The European Central Bank has cut its interest rate to 0.5%. Can this really help the crisis countries in Europe?
Now, the measure itself, which is 25 basis points, will probably have a negligible impact. But you have to see the level is extremely low. It has been extremely low for quite some time with 0.5. Also other measures like the liquidity provision and most importantly, the OMT program, the promise under certain conditions to buy government bonds in an unlimited quantity from countries in trouble. I mean, this has helped financial markets quite a bit. So it's supporting and helping to stabilize the economy, but you have to see that we have quite some headwinds coming from fiscal and private sector consolidation. So the ECB, and I mean, Mr. Draghi has been quite frank on that one, has been doing whatever it, almost what it can, you know, which is in line with its mandate, and even there it has stretched its mandate quite a bit, but there is little monetary policy can do on top of that.
So it's just a stabilization. Stimulating is a different topic. What could stimulate the economy in Europe right now?
I mean, it's very hard to see as long as we don't, you know, go down the route of the Bank of Japan, you know, trying to double money supply over just 1 or 2 years. I think monetary policy again, there are certain limits. Fiscal policy again, I mean, it's clear that we are still on a consolidation path. Deficits have to be reduced. Although we have seen that the Commission has given France and Italy 2 years more time to get the deficit below the 3% threshold. So that helps a little bit, but there is no quick fix. We have to do reforms. I think what the politicians, especially if you look at countries like Italy, so they have to come up with credible governments and credible policies to maintain market confidence, but it's a long uphill battle.
We will talk about these reforms later on. In our focus interview this month, we talk about ways and means to stimulate the economy in Europe. You can watch the full interview on www.dw.de/English/Made in Germany.